Welcome back to the Biotech Investor Channel. I'm thrilled you are here because today we have some exciting news to dive into. Iovance Therapeutics, ticker symbol IOVA, has just released their third quarter 2024 earnings report, and the stock price went on a freefall. You might think it's just another earnings report, but there's more beneath the surface as the stock tumbled more than 30%. All of this while Iovance beat revenue expectations and are making significant strides in cancer treatment innovation. Stick around because we will uncover the key highlights and potential catalysts for next quarter and next year. We will also discuss the risks you need to be aware of and whether the current share price truly reflects the company's fair value. So, if you are interested in biotech investments that could offer substantial returns but also want to be mindful the risks, you are in the right place. Let's get started. You might assume that meeting revenue guidance is good enough, but Iovance didn't just meet expectations, they blew past them. They reported total product revenue of $58.6 million for Q3, exceeding the high end of their own guidance, which was $53 to $55 million. This isn't just from one product, but from two key revenue streams. $42.1 million from Amtagvi, their FDA-approved TIL therapy for advanced melanoma, and the rest, $16.5 million from Proleukin, which complements Amtagvi in treatment. Patient adoption is also accelerating, with 146 patients treated since April, and infusions ramping up as well, with 25 in Q2, 82 in Q3, and already more than 39 by the end of September. This isn't just a lucky quarter, it is a trend. But what's driving this growth? Most people expect that launching a new therapy would face hurdles, but Iovance is overcoming them impressively. They've established 56 authorized treatment centers and aim for 70 by year end. Typically, getting financial clearance and/or insurance approvals can slow things down, but they've reduced this time from 4 to 6 weeks down to just 3 weeks. Financial access is often a challenge for such an expensive treatment, but Amtagvi boasts broad patient access. 75% of patients are covered by private payers, and over 95% of US covered lives have reimbursement access. They could have rested on their laurels with just hospital centers, but they're also engaging in community outreach initiatives, driving even more demand. This strategic execution isn't just good news for patients, but also for investors looking for sustained growth. Scaling up manufacturing is no small feat. It could be a bottleneck, but Iovance is handling it adeptly. They operate 2 FDA-approved manufacturing facilities. One, the Iovance Cell Therapy Center, ICTC, in Philadelphia, and they've added a contract manufacturing facility for added flexibility. Investors worry about long production times, but Iovance have consistently delivered a 34-day turnaround, aiming to reduce it even further, which would help save lives and, less important, to avoid financial losses that result from manufacturing an infusion to only then have to discard it. Capacity might seem limited, but they have plans to expand. From serving over 2,000 patients annually, which is the goal now, to over 5,000 patients in the next couple of years, and eventually over 10,000 patients annually. Efficiency improvements aren't just operational, but they're also financial. They're targeting gross margins of over 70% in the coming years, with a little over 35% currently. So manufacturing isn't just keeping pace with demand, it is positioned to drive future growth. While high revenues are great, but what about profitability and cash flow? Iovance is reaffirming 2024 guidance of $160 to $165 million and the forward-looking guidance 2025 between $450 to $475 million. You might expect margins to be thin in early stages, but their gross margins are improving, with already more than halfway to their 70% target. Now let's look at Iovance's cash position. They're sitting on $403.8 million as of September 30th, expected to fund operations into 2026. The net loss here might be a concern, but it's decreasing. In Q3, the net loss is of $83.5 million, 28 cents per share. an improvement from last year's same period. The cash burn for full year 2024 guidance is $320 to $340 million, excluding a one-time expense. Financially, they're not just growing revenue, but also improving operational efficiency and extending their runway. Now let's look at the pipeline and future catalysts. Their current products aren't the whole story. The stock price only showcases their current earnings with Amtagvi and Proleukin for treating melanoma, ignoring all of its pipeline potential and future growth. Let's talk about something in their pipeline, which is non-small cell lung cancer therapies. In one of the trial results for non-small cell lung cancer, combining lifileucel plus pembrolizumab, which is Keytruda, showed a 64.3% response rate in EGFR wild-type patients. EGFR stands for epidermal growth factor receptor. Wild-type means the EGFR gene is normal, not mutated. Some cancers have mutations in this gene, which can affect how the disease behaves and how it responds to treatment. Iovance is also planning to launch Cohort 3D to enhance these results. In clinical trials, a cohort is a group of patients who are part of a study. Cohort 3D refers to a new group that the researchers are planning to include. The goal is to improve upon the already promising outcome they have seen. With the expectation of even better results, Iovance is aiming for accelerated US approval in 2027. In regards to frontline advanced melanoma, the Iovance 301 phase 3 trial is ongoing. The trial results could support accelerated and full approvals when combined with pembrolizumab or Keytruda. And last but not least, endometrial cancer trial, which is the IOVA 201. This trial is targeting a significant unmet need post-anti-PD-1. These aren't just incremental improvements, but potential game changers in cancer therapy. Now that we've covered a summary of what's happening on the pipeline, let's look at what they're doing to expand their treatments across the globe. In Europe, the EMA has accepted their application. They expect an approval in the second half of 2025. In the United Kingdom, MHRA is reviewing their application. They expect an approval in the first half of 2025. Third, in Canada, submission is underway with a potential approval in mid-2025. They could limit themselves to these markets, but they're also planning submissions in Australia and Switzerland for 2025. International approvals won't just increase their market size, but also diversify revenue streams. Everything sounds promising, but it's crucial to consider the risks. Scaling up is complex, and any hiccups could delay treatments. The oncology space is crowded. Other companies are developing similar therapies. Approvals could face delays due to unforeseen struggles. Operating at a net loss means they need to achieve profitability to be able to sustain growth. Some pipeline therapies might not succeed in later stages. Being aware of these risks doesn't negate the opportunities, but it helps you make a more informed decision. An investor's job is to find out if the stock is undervalued or overvalued. Now, let's break down the numbers to find a fair share price based on their 2025 revenue guidance. The current share price is sitting under $8.30. The number of shares outstanding is 303.27 million, which makes a market cap of approximately $2.5 billion. The 2025 revenue guidance is between $450 and $475 million, with a midpoint of $462.5 million. To determine a fair share price, we will use the price-to-sales ratio, which is a common valuation metric in biotech sector. The industry average price-to-sales ratio typically ranges from 5 to 10 times, depending on the growth prospects and risk factors. Let's go with the lowest estimate, which is a 5 price-to-sales ratio, meaning possibly no growth. That would bring us to a market cap of $2.3 billion, which means around $7.62 per share. Now, if we look at a mid-estimate of 7.5 price-to-sales ratio, that would bring us to $3.4 billion market cap, or around $11.42 per share. But if we go with the high estimate, with a price-to-sales ratio of 10, expecting, good sales and good expansion, that would bring us to $4.6 billion in market cap, or around $15 per share. Given Iovance's strong growth trajectory, expanding pipeline, and international opportunities, the fair share price should be reasonably between $11 and $15 based on a 7.5 to 10 price to sales ratio. This suggests that at the current trading price of $8.30, the stock may be way undervalued, presenting potential upside for investors. But it's essential to weigh this against the risks we discussed earlier. While the growth prospects are promising, factors like manufacturing challenges, regulatory hurdles, and competition could impact future performance. Now, the million-dollar question. Why did the stock price drop more than 20% seconds after the earnings were public? There were rumors about an at-the-money offering, also rumors about Wayne Rothbaum cashing out, and even rumors of a short attack. The most probable reason that I can find, and I believe, is that algo trading takes milliseconds to take in earnings data, do the math, and get to a share value based on quarter results. And since the quarter results showed a decent growth and not spectacular, the algos probably decided that the stock was overvalued at the current earnings and sold and or shorted the stock. This, combined with the 10-year bond raise and the RFK Jr. appointment, caused the perfect storm to bring the stock price down to a very attractive valuation. Remember, this is not financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. So, what's the takeaway? Iovance is exceeding expectations and not just meeting them. They're rapidly expanding their treatment centers and manufacturing capacity. Their pipeline is robust, offering multiple shots on goal for future growth. International expansion could significantly boost their market reach. There are risks, of course, but the potential rewards could be substantial. The key things and catalysts to watch are updates on their clinical trial in non-small cell lung cancer and frontline melanoma as well. Progress on international regulatory approvals could also be a catalyst, and of course, if we see a continuation in growth in patient treatment and revenue. Some of the risks to monitor: any manufacturing challenges that they might encounter could move the stock price down, or any competitive developments like Summit Therapeutics, for example. So before you make any investment decisions, consider both the opportunities and the risks. If you found this video valuable, please give it a thumbs up and subscribe for more insights. I have a question for you. Do you believe Iovance is poised for significant growth, or do the risks at this moment outweigh the potential rewards? Please share your thoughts in the comments below. And remember, this video is for informational purposes only and should not be considered financial advice. Until next time, happy investing.